Booyah! That's the feeling we're chasing, right? The thrill of a successful trade, the satisfaction of knowing you made the right call, tired of staring at stock charts that look like a complete mess, a jumbled puzzle with no solution in sight. Do you feel lost in a sea of red and green, unsure of which way to turn? What if I told you there's a hidden code embedded within the market's movements? A secret language whispered through the charts. A pattern, a reliable indicator that can help you spot potential buy and sell zones with uncanny accuracy, even before the rest of the crowd catches on. This isn't some kind of magic trick or a get-rich-quick scheme. It's a powerful tool that seasoned traders have relied on for decades, the elegance and precision of Fibonacci. I know, it sounds like a type of pasta, maybe something you'd order for dinner, but trust me, it's a powerful way to decipher and read the market's underlying rhythm, its natural ebb and flow. Stocks, like the ocean, move in waves, not in predictable straight lines. Fibonacci helps you predict with greater confidence where those waves might temporarily pause, consolidate, or dramatically reverse direction. It's your personalized roadmap, guiding you through the market's twists and turns, highlighting key levels where big institutional money might be poised to jump in, creating buying pressure or cash out, triggering a sell-off. Imagine your favorite stock suddenly surges upward with incredible momentum. You unfortunately missed the initial move, and now you're eagerly waiting to get in on a dip, a slight pullback. Fibonacci analysis precisely shows you the most probable areas where that dip might find support and ultimately end. By diligently learning and mastering these key Fibonacci levels, you'll be empowered to make smarter, more informed, and ultimately more confident trading decisions. No advanced mathematics degree or PhD is needed to grasp these concepts. We'll break down each concept step by step in a clear and easy-to-understand manner, and together, we'll transform those confusing, intimidating charts into a clear and actionable treasure map. So, are you ready to finally crack the code and unlock the market's hidden potential? Let's dive right in and get started. The real money-making action, the path to consistent profitability, starts right now. So, who exactly Fibonacci? What's the story behind this name that keeps popping up in trading circles? Hundreds of years ago, in the heart of medieval Italy, Leonardo of Pisa, later known as Fibonacci, stumbled upon a sequence, a numerical pattern, 0, 1, 1, 2, 3, 5, 8, 13, and so on, stretching into infinity. Each number is the sum of the two preceding ones. Now here's where it gets interesting. Divide one number in the sequence by the next number in line, and you get approximately 0.618. This is a key ratio, but let's take it a step further. Go two places over in the sequence, and you get approximately 0.382. These, my friends, are the famous Fibonacci ratios, and they are far more than just numbers on a page. These ratios show up everywhere. In nature, in the proportions of classical art, and yes, perhaps surprisingly, even in the stock market. So why do traders care about something that sounds like it belongs in a math textbook? Because human emotions, those unpredictable forces, drive markets in waves, creating patterns of buying and selling, and these Fibonacci ratios often mark key levels where those waves tend to pause, find support, or dramatically reverse direction. The key levels we watch, 23.6%, 38.2%, 50%, and 61.8%. These become magnets for price action, points of attraction that the market seems drawn to. Think of it like a rubber band stretch, snap back, repeat, usually by a predictable amount, guided by these ratios. Now, the 50% level isn't an official Fibonacci ratio, but traders love it and watch it closely as a halfway point in a price swing. Mastering these levels means you're anticipating the market's next move with a higher degree of probability, not just reacting to the chaos. It's chess, not checkers, and Fibonacci can be a powerful piece in your trading strategy. Enough theory, let's get practical. Every trading platform has a Fibonacci retracement tool. Find it in your drawing tools. To use it in an uptrend, click the swing low, drag to the swing high, and release. The tool overlays the key levels. For a downtrend, do the reverse, swing high to swing low. These levels now show where price might bounce, support, or stall, resistance. The trick? Pick obvious, major moves. Ignore tiny wiggles. The bigger the swing, the more traders are watching, and the more reliable the levels. Practice on different charts. Draw your lines and see how often price respects them. This is your new secret weapon. Homework. Try it out. You've drawn your Fibonacci lines. Now what do you do with them? How can these levels guide your trading decisions? In an uptrend, as price inevitably pulls back, keep a close watch on the 38.2% Fibonacci retracement level. This is often the first area where buyers may step in, potentially offering a good entry point. Also, the 50% level is another key area to observe. And don't forget the 61.8% level, which is often considered a critical support zone. Many traders view this as the last line of defense before an uptrend might be in jeopardy. Don't just blindly buy the moment price hits a Fibonacci level. That's a recipe for potential disaster. Instead, wait for confirmation that the level is indeed acting as support. Look for signals like a bullish candlestick pattern forming right at the level, or a significant spike in volume, indicating renewed buying interest. Let's look at an example. Imagine a stock runs from $100 to $150, establishing a clear uptrend. Now draw your Fibonacci retracement tool, anchoring it from the low to the high of that move. If the price then pulls back to, say, $131, which aligns with the 38.2% Fibonacci level, that's your cue to start watching closely for a reversal signal suggesting the pullback is ending and the uptrend may resume. Beyond identifying potential entry points, these Fibonacci levels also provide valuable guidance for managing your risk. If you decide to enter a trade at a Fibonacci level, a smart strategy is to set your stop-loss order just below the next Fibonacci level down. This way, if the price breaks below the level where you entered, indicating that your initial assessment was incorrect, your potential loss is limited and controlled. Remember, Fibonacci retracement isn't just a tool for identifying buying opportunities. It's equally useful for determining where to take profits on your winning trades. In a downtrend, you can use the Fibonacci extension levels as potential targets to cover your short positions and lock in your gains. Ultimately, Fibonacci retracement provides a complete framework for your trading strategy, guiding your entry points, setting your stop-loss levels, and defining your profit targets. It puts professional-grade risk management tools right at your fingertips, empowering you to make more informed decisions. Use it wisely to protect your capital, stay in the trading game for the long haul, and consistently lock in those hard-earned gains. That's how the pros approach the market, using Fibonacci to trade with precision and confidence. Fibonacci is powerful, but not a crystal ball. Don't treat these levels as guaranteed turning points. Wait for confirmation, like a reversal pattern or a volume surge. Never rely on just one tool. Combine Fibonacci with other indicators for stronger signals. Another mistake, picking the wrong swing points. Use major, obvious moves. Ignore minor wiggles. Zoom out to find the real trend. The more significant the swing, the more reliable the levels. Don't force it. If there's no clear swing, move on. Check multiple time frames. If a level lines up on daily and weekly charts, it's extra powerful. That's called confluence. Multiple signals, one story. Avoid these mistakes and you'll separate yourself from losing traders. Be patient, be smart, and use Fibonacci as part of a bigger plan. That's how you win. Let's wrap it up. The market moves in waves, and Fibonacci helps you decode those waves. Use the tool to draw retracement levels on clear price swings. Watch how price reacts at 23.6%, 38.2%, 50%, and 61.8%. Don't trade blindly. Wait for confirmation and always use a stop loss. Combine Fibonacci with other analysis for stronger trades. Stack the odds in your favor, manage risk, and build wealth over time. Practice on paper, build your confidence, and master the skill. You now have a tool most traders ignore. Use it to trade smarter. Now get out there, draw those lines, and trade like a pro. Booyah!